Hello everyone, this is Juan Sarmiento and today is Friday, August the 20th. Okay, I just recorded myself and there was a crash in the system, my system, so my recording wasn't saved. So I did some operations there and they weren't recorded. So it might sound like I did this before, but I went through all my trades here and I looked at their advantage and disadvantages of rolling it up. And this is Adobe. You can see here is reaching new highs, and I was thinking whether I could do. Look at it here. It's already over my smiley face, so you can take profits when you see that. However, I'm tempted to leave it alone because it's moving really strongly right now. So what I could do is simply sell a higher strike price call. You can see that I already have a roll up, meaning I had two 590 calls. Now I have one 590 call and one 630 call. That's my roll up. It's a way to take profits, but the stock has kept on going higher. So in this case, the 630 call can be rolled up to 650 now that's we're approaching that. To do that, we do this vertical spread, this diagonal, which is essentially sell the 630 and buy the 650, assuming that the stock will continue to go higher. But if it's go lower, it's a way to take my profits. If I did that, notice the delta is 17 now. If I did that, it lowers it to 5. So I don't want to do that. Perhaps next week we'll do that. I think Adobe might continue to go higher, and I feel bullish about it, so I'm not going to do anything. Then we have the other possibility would be to simply sell a higher strike price to make a vertical or a diagonal with this single stock here. This is the bullish call. If I sell one higher strike price, then it becomes a vertical with $625 risk in the potential to make 2,300. Okay, that's one thing you can do. I don't particularly like that. You can lower the strike price or change the expiration to an earlier date. Whatever you decide to do, make sure that your chart graph makes sense. Okay, so if we were to do that, though, it would be very negative, very bearish, and I'm not bearish at all on Adobe, so I'm not going to do anything. Then we have DHR. DHR is we already took profits on it, so we are only looking for the possibility of the stock collapsing. But we have taken our profits as we went along, and now we have this vertical spread here, and that's pretty good right there. We could sell that. Okay, let's move on to Msm Hca, and this looks very bullish, and the stock is bullish right now. I think it's going to break through this double top here, and that's a very bullish setup. The shorts expire in September, so I'm not going to do anything about that. Same here with CarMax. The shorts expire in September. Low is the one stock that I just bought. I'm going to explain that very swiftly. Come back to it in a minute. Here we have the MS. What I've done is, I don't know if you remember last week, I rolled up the call, but I left the put alone. Well, this put now that expires today is going to expire worthless. So the thing to do would be to sell a September 95 put, and I did sell at the 95 cents. Okay, because this is something I just did, and I lost my recording. So I'm just telling you that that's what I did just a few minutes ago. You want to see that? Well, I have it here. Okay, it at 1850 now is here in Spain is 1859. Okay, so only a few minutes ago I got this filled. Unfortunately, my recording was somehow damaged, an error there. Okay, so, but that's what you would do, because this August 20 is going to expire worthless, and selling the September put is worth something, I did just that. Okay, and then imagine that this August put is going to go away shortly, and this is what you end up with, and that looks pretty nice. Okay, and the next shorts are expiring in September the 10th. Nike, I did not do anything. Looks bearish. Let's take a look at the chart, and Nike still looks bearish to me. Okay, so I'm gonna leave it the way it is. SPY, no, that's not a trade here, it's for the other account. And Yum looks also very yummy. It's got September the 3rd expiration, no need to change anything. Okay, the low, I have the chart here. Low, this is the trade I'm going to do. I'm going to show it to you right now. Let's go to the Analyze tab. What I got filled, okay? Analyze trade. And here it is. Let's hide that. And this is the trade as I entered it. $45, $30 price. This is the this has changed obviously since I entered it, but I copied this volatility into my spreadsheet here. Okay, and these were the numbers. The difference between the back month options, this is an average of the two, 27.58, and the front month, the average of the front month is 25.20. The difference is 2.38. Since it's less than 3%, you can trade. The liquidity, the way you calculate that, again, create duplicate, and you see mid and natural. So you take those two numbers, enter them here. Mid 44.98, it's gone a little bit higher now, and natural 45.7. Difference 1.6. If this is 5%, I believe, or 3% as well, then I wouldn't trade it, or it would be a strike against it. Current IV percentile is 21%. Let's go to the trade tab and scroll down until you see current IV percentile here on today's option statistics. 20% is a little higher than I would accept, but in this case it's good enough because we have 2 or 3 of the criteria to be good enough. I look at the chart and I see the movement here. That's very aggressive movement for 3 days, so it looks good. All right, so I'm going to enter that trade, or I did, and it got filled at $45.30. Okay, and you see the dates, the expirations here. September 24th. You can use September 17 if you want, and 21 will be the expiration of the front month. That's it. All right. That's all for today. Thank you very much for joining me, and I'll see you next time. Bye-bye.